Welcome back to Equity Builders with our second episode of the weekly watch list. We're going to start it off by talking about Square. So Square is a company that is all about convenience. And one of the biggest things that they have is this app called the Cash App, and I'm sure you've heard of it. It's the easiest way to send money as well as the safest way. That's their claim. And a lot of people like that. There's no social media factor like other of those Cash App type apps. If you think about Venmo, there's where other people can see what you're sending to certain people, and a lot of people don't like that. So they're all about convenience. It's easier to do than run into your friend's house to give them cash or something like that. Someone can buy it for you. You call your mom, and she's like, "Hey, do you want this new Xbox?" You can Cash App her for it. You know what I mean? Something like that. You guys probably aren't asking your mom for Xboxes, but you know what I mean. It's for the younger generation, and those are the ones that are ruling the stock market right now. Yeah. So with that being said, with Cash App, you'll see a lot of people using it. It's very easy. People are talking about it all the time. They're constantly paying people. You'll see on YouTube all the time, constantly paying people for advertisement space. Constant. You see it everywhere. I see it everywhere, especially with friends, with family, all that kind of stuff. I'm going to give it off to Vasily here because he's going to talk about some of the logistics stuff behind that and what other things Square does.
Okay, yeah, so that's basically covering the consumer side of Square. So obviously we've talked about Cash App. It's a great way to send and receive money. Let's really get into the meat of what they do, though, and that's kind of help small businesses with their payment solutions. So what do I mean by that? If you've ever gone to a small merchant business, you've probably seen a Square register before. Some in-house payment solutions include like registers, things like that, card processing, touchless payments they even do now, and certain businesses like local coffee shops might use it, things like that. So they make a little bit of revenue from that and point of sale. So they'll skim a little bit of money off the merchant sales. So it's basically like they have a little slice of the profit from the business. It's a very small percentage, but this accrues to a larger number with the amount of businesses they've recruited, which is good whenever you're looking at their revenue growth over a long period of time. And speaking of that, year over year in 2019, 41% growth year over year from quarter four in 2018. That's great growth. And they've grown the company to be able to net $1.31 billion of net income. That is huge. This company has exploded over the last year, as you can see on my 1 year graph right here. Tremendous 159% growth. It is a bit overvalued right now. So if we go down and look at the price to earnings ratio, it's trading at 260 price to earnings, which obviously I cannot justify right now. It's way overvalued if you look at it. But do I think you should still buy the stock? I'm not an advisor. Will I keep buying this stock? Yes, it is going to explode in my opinion. Great buy long term. You really can't go wrong with it, in my opinion. Other than that, it does not offer a dividend, but most high growth, explosive plays like this, like your Shopify, stuff like that, they're not really going to need to offer a dividend. The capital gains you're probably going to get off of an investment in Square is going to be tremendous. I'm very bullish on the company. I'm holding a little bit, as you can see in my portfolio right here. And I will continue to buy Square as we go on moving forward. I don't have any bad things to say about them really. So I do have a little bit of bias in that case, but they do have a tremendous opportunity in the small business market. Another thing that Square does is they have started lending to small business owners. So this could potentially disrupt the banking space. As we've seen with ARK Invest, they've been adding a tremendous amount of shares over the last couple of years in Square because they also believe that their lending habits over these past couple of years could potentially disrupt the banking space. So what do I mean by that? If you're looking to start a small business, traditionally you would go to a bank, right? You'd go into the bank, ask for a loan. Square is interrupting this and saying, hey, we know you're going to use this for your card or payment processing, so, why don't we just give you the loan? Like, we're more flexible, we can get you the money faster, and a lot of business owners have been taking advantage of this. This is a great deal for Square. They're lending, they're making money off of the capital lended to these small business owners, and it's way more convenient. It's very easy to use, and I see tons of businesses adopting this in the future. I don't know what you think, but
I mean, I like with the lending, obviously that stuff can be risky, but they're a big enough company and they have enough money coming in that it shouldn't be too big of a deal. They can always just stop giving out loans if they have to. But what I like is they have a marketing strategy almost like a credit card company. So they're taking minuscule, as you'd say, off the top of every card transaction. But that's exactly what those like Visa and MasterCard are doing with other businesses. If you use their card, which through Cash App, you can also get a card, same process there.
Square card.
They're following the exact strategy that those big names like MasterCard and Visa are doing. So they're bringing in money a bunch of different ways, and I like to see that.
Yeah, they've definitely returned a tremendous amount of value to their shareholders. It is overvalued right now. Most stocks that are high growth stocks are overvalued right now. The market has been a little bit inflated, but out of all the high growth stocks, I think this one is still a buy. Tesla's controversial. We're not going to get into it. Huge PE. This one's got a huge PE too, but I will keep buying this one because I don't think it's hit the ridiculous point yet, like some other things. Very bullish on Tesla as well, but I will keep buying Square for now. I'm cooling off on Tesla at the moment. Anyway, with that being said, I think this is a great one that you should definitely consider this week. And moving forward, honestly. I will keep adding this throughout the end of the year, next year, and years to come. So with that being said, that concludes our first one. On to the next, which will be Honeywell.
So when I was looking through stocks for our weekly watch list, I was kind of looking at things in the aerospace division. So I was looking at different things like Boeing, and then I was like, maybe I can do like airline. Like maybe there's one airline that sticks out to me. And going through all that stuff, it's looking like you're not going to make any real money until like 2 or 3 years down the road. So yeah, maybe a good time to invest. But I came across Honeywell, and this is a stock that I was looking at a few months ago and kind of forgot about, and I kind of wish I didn't. So Honeywell is big in aerospace. That's their biggest division, but they're a multinational conglomerate. So they got stuff all over. They got different types of technology. They're big in cybersecurity, safety, different technology things. They're all over the place. You can find them in pretty much anything. And what happened on August 31st was they joined the S&P 500. So we've already seen a little bit of the growth from that, just like from the news breaking, everything like that. But now is still, in my opinion, a pretty good time to buy, just because once a stock hits the S&P 500, normally, unless there's some unforeseen circumstance like we've seen over the past few months, they're going to grow. And even though the aerospace division, their biggest division, is down right now, they're still making money and their stock is still rising. So they're the number one producer of the N95 masks that's obviously needed for the virus and everything that's going on. But even before that, from like 2012 to 2016, they were seeing consistent growth. And then over the past 5 years, they started to blow up and they started to grow like crazy. One thing that is really like something that catches my eye is before everything happened in 2020, they signed a deal with the Air Force for a 4-year deal. And obviously that's for their aerospace division, which is kind of hurting, but they're still making money, so it's not a big deal. But they signed a 4-year deal with the Air Force, and in that contract, there's potential for a 15-year deal. So after everything's over, if they can fulfill on what they promised, they got a potential of a $3.5 billion deal with the Air Force, and the Air Force isn't going anywhere. So I have a hunch for myself, and I feel good about it. Investing in Honeywell, I can make some money. It's a value buy, and they have a pretty good dividend yield also, as you can see on the Robinhood account that we're using or we're following just to help track our stocks and stuff like that. Also, Vasily has some other stuff, a little bit more of the numbers to crunch and all that kind of stuff that he's a little bit better than I am with.
Yeah, and speaking about that, as we can see on the yearly graph right here, the stock is still a little bit beaten down from its February norms at 179. It's pretty much trading at $7 under that consistently right now. The price to earnings is very attractive on this business. It's looking like a great value buy right here at 20. And they offer a 2.17 dividend yield. The great thing about this versus other stocks is that they're spread across so many sectors, guys. Tons of other stocks will give you better yields. They'll have better price to earnings, but to me, they just won't give you the safety that this one offers. And when I say that they're spread across so many sectors, it's really true. And as he mentioned, they have opportunity with very stable deals in place, which can give some investors some ease in that scenario. So I definitely think this one is a more conservative play, and it's definitely still got room to grow, but it's a great way to get some money back off of your initial capital invested, in my opinion.
Yeah, and what you're saying with safety is they're, $7 under what they were trading at 6 months ago?
Yep.
And they don't even have their biggest division running properly.
Yeah, that's a good sign.
And not properly because of their fault, but because of what's happening around the world and especially in the U.S.
Yeah.
So once that comes back, probably going to see growth from them because of their deal with the military. You're going to see that same safety because those other commercial industries aren't going to be able to come back right away. They're going to have other protocols and stuff they're going to have to follow. They're going to have to spend money before they can make money, while they have a deal with the military to where they can just come back guns a-blazing. And they can start making that money and bring in more revenue almost right away. So I have a strong feeling that they're going to continue to grow before that even happens. So there's room over the next 6 months to a year, whenever all of this ends, that you can make a good chunk of money as well as get dividends off of that.
Yeah. So definitely, guys, you're definitely going to win on both fronts, capital appreciation-wise and dividend income-wise, stably. And this is definitely a more defensive play, in my opinion, but still a great one at that. So.
And for our next play this week, we're going to talk about Disney, a stock that you guys obviously know about. You hear about it all the time. They're huge, and there might be a way that you can make some money off of them.
All right, guys, so with Disney stock here, we're just going to talk about a little bit of why we think it's a great buying opportunity right now and moving forward long term. So obviously, everybody knows Disney. It was founded like 100 years ago or something like that, 1923. We can see the 5-year graph here. They've been trading kind of choppy, kind of sideways. They started picking up after they released their streaming service, Disney Plus, which has done very well in the scenario that we are in the world right now. We had a dip, just like the whole stock market did, and we can see them slightly recover on the 5-year graph. The reason I'm looking at this currently is because they offer a great dividend yield, and their price to earnings is actually pretty decent when all their parks is open. So this is a stock that is classified in my portfolio when I add it, because I am looking to add it soon, as a forever stock. This is a stock with a great competitive advantage. You're going to have crazy brand recognition. Everybody loves their movies. All kids all over the place love their movies. Everybody loves Star Wars. I'm pretty sure they own Lucasfilm, if I'm not if I'm not mistaken. So crazy brand recognition, guys. Moving forward, they're adapting to changing business environments with their streaming platform now. They're going to keep finding and pioneering new ways to make money, and it's just going to bring crazy return to their investors, in my opinion. This is one that I see great capital appreciation off of moving forward if you're patient. It's not going to happen immediately because, like we said, some of the parks are closed right now. But you'll also receive a nice, juicy dividend out of this one, even though it is only 1.3% right now. I think that over the long term, this can have a meaningful impact in any portfolio and stabilize it.
Yeah, absolutely. One thing with Disney is it's worldwide. And realistically, they own the movie-making space for anyone under the age of 18. They own it. They own all the cartoons. They have all the best films that people would say.
Yeah.
Their streaming platform had like 3 new series and movies. 3 like total. They've made so much money off of the streaming service of movies that have came out over the past 60 years.
Yeah.
Movies that they've already released.
Genius.
And not to mention with AMC theaters supposedly opening up in different states. Well, a few did a few weeks ago, but they're opening up like nationwide. They're going to bust out more movies. They're going to make more money off box offices. They're going to make more money off their parks. This is a stock that always grows 4 years, and if you hold on to it, you're going to make your money. They've
Yep.
split their stocks 8 times, so their stocks would be viable for normal consumers like you and me.
Yeah.
8 times. That is insane. They've been around for that long. They've been trading for that
That is a
long,
lot.
and they have split their stocks 8 times. That's not something that you just see with any normal company. It's a safe investment. They're always going to be there because people from all over the globe come to California and Florida just to go to the parks for a week.
Yep.
And not to mention how expensive their ticket prices are, but they stay at their resorts, which are 5 times more expensive.
Yep.
They're making money, and they're not going to stop.
And it's
No
a
matter
recurring
what.
thing. People that have been to Disney World and experience it like it and come back. Like,
Yep.
it's not like it's a one and done type of thing. Like, and it's at a discount, guys. Like the price right here, we're seeing like $135 share price right now, right? November it was peaking at $151, which I think is still doable and will exceed in the future. But people are a little bit apprehensive because the parks are closed. I don't know why. Disney's not going anywhere. Like, it's gonna recover. It's just a matter of time, honestly. But this is a forever stock that I will be looking to adding soon into my own portfolio, and I think that would be great to add to any portfolio. You have anything else to say?
Nothing much. Just thanks for stopping by for episode 2 of the Weekly Watch List, and we hope to see you again soon.
Yep, and just remember, guys, we are not financial advisors, so do your own due diligence, but I think this has been a pretty comprehensive review of this week, and we hope to see you in the next episode.